The S&P 500 posted a record close yesterday. The third time it's done that just this week. Maybe partly because the markets have finally learned to stop worrying and trust the Fed's read on inflation. Steve Leisman joins us now with more. Steve, good morning.
Good morning, Joe. Yeah, call this story How the Markets Learn to Stop Worrying, and love the idea of temporary inflation. Over the past several weeks, it looks like the markets have embraced the Fed's outlook that there will be a coming burst of inflation, but that burst will be only temporary. That conviction is going to be tested again today with the release of wholesale prices at 8:30 and again next Tuesday with consumer prices. Fed Chair Jay Powell, in a discussion yesterday with CNBC's own Sarah Eisen, repeated his "it's only temporary" mantra.
Have a situation where the economy is reopening. There'll be a surge in demand, perhaps. There will be bottlenecks, perhaps. But it seems unlikely that that will change the underlying inflation psychology that has taken deep roots over the course of many, many years. So that's what we think. We think that there will be upward pressure on prices, which may be passed along to consumers in the form of price increases. We think that effect will be temporary.
Heard that before. That idea looks to be winning out in markets, though, where inflation expectations, as measured in the TIPS market, they've cooled off since the end of March. You can see that little decline there, reversing a steady climb upward and coinciding with the latest March higher in stocks. Now, the headline of the Producer Price Index expected to rise 0.4%, get up near 3% year on year for another strong gain. And it comes the day after GM announced it would idle some car production because of a chip shortage. That shortage just one sign of supply disruptions and bottlenecks that have racked supply chains and manufacturers around the globe and threatened to push up prices. What's unclear and what's important here, how much of that ends up in consumer prices. The Fed says it will be, temporary. And for now, Joe, markets seem to believe them.
I like your question, Steve, which we'll get to in a second. But can I approach it in a different way? Because it harkens back to and I'm talking about a question that you're suggesting that I asked you because it's a good one about, the Fed, doesn't, they look at how the economy and projections for how that's going to work and they go, we're not worried about that. But they look at inflationary expectations and they say, yeah, well, we believe those. But we talked, remember, about whether the Fed can really orchestrate a 10-year or whether the 10-year is going to, it's such a big market globally that it's going to do it at once. Isn't the easing of worry or what you're seeing in terms of the tips, isn't that the market sort of giving us that signal? We don't necessarily have to believe the Fed. We can believe what the market just told us in the last 3 weeks or 4 weeks.
Joe, I don't think it's that clear cut. I think there's this relationship where the market says, we're worried about inflation. The Fed says it's temporary, and the market says we either believe the Fed or we don't. And I think there's two aspects to the belief of the Fed. One is that you believe or you don't their forecast. And the second is you feel comfortable that the Fed kind of has your back on this, that at some point, if inflation gets out of control and moves from the temporary to the sustained point of view, that the Fed will act. And I think that's also been a part of the rhetoric, Joe.
Shepard Smith here. Thanks for watching CNBC on YouTube.